Hello everyone, my name is Jason Parisella and welcome to Jason's in the House. Nice to be with you again. I'm a real estate agent with Keller Williams Realty right here in Bellevue at the Cumming Center. And our guest today is Stacy Snowden. She's with Prospect Mortgage, and actually her office is right inside our office at the Cumming Center. And so Stacy, it's nice to have you with us today, and why don't you tell us a little bit about yourself and your company?
Sure, thank you for having me today. Well, let's see, I grew up in Saugus. I'm a graduate of Suffolk University. I've continued on to Northeastern for my paralegal certificate. And after 8 years in banking, 4 years as a real estate paralegal, I decided to combine all my experience and get into the mortgage field. And I've been doing this for about 9 years. I joined Prospect Mortgage about a year and a half ago, which has proven to be a great company. They're a well-recognized national, we're a direct lender, so we do lend our own money. We offer a vast array of programs, including conventional, FHA, and the 203K rehab loan, which has been very busy these days. We are backed by Sterling Partners, and it's a good company. I'm happy to be here.
Now, just curious, have you worked, we're going to go into this next, have you worked, since you've been a loan officer, you've been only with a mortgage company, or you've been with a bank, or?
I previously worked for a mortgage broker.
Oh, okay.
And now we are a mortgage lender, which is a little bit different.
So let's go through that. What's the difference between a mortgage broker, a lender, and well, actually, if you go to your local bank, which a lot of these banks aren't local anymore, they're so big, but a bank, a mortgage broker, and a mortgage company.
Okay. Your typical bank, they're kind of like a full service. They might offer insurance, investment options as well, and they typically lend their own money. A mortgage lender strictly does mortgages. They do lend their own money, and they sell the loans off to Fannie Mae and Freddie Mac on the secondary market. Whereas a broker, they basically arrange the loans. They don't lend their own funds. They're a correspondent between the investors and the borrowers. They streamline the paperwork. But they don't actually originate or fund the loan.
So a broker is like almost as a typical broker would do in any industry, like a middleman.
Right.
Okay.
Prospect is a direct lender,
Coordinating
so we do lend our own money, originate and fund our own loans.
So if somebody goes through Prospect Mortgage, when they go to the closing, is the loan being funded with Prospect Mortgage through that?
Prospect Mortgage's own money.
And what happens after the closing with that loan?
Typically, as in probably 95% of the cases, they do hold them for a little while. They do portfolio some of the loans when they keep them in-house and service them themselves. The majority of them do get sold off to the secondary market, and basically they make in room so that they can go out and give more mortgages, so they won't get sold.
Okay, so is it typical for a mortgage company that they close in their own name? What happens after that when someone gets their statement? Are they getting it from Prospect Mortgage, or once it's sold, it's from somebody else?
What's going to happen at the closing, you're going to get what's called a first payment letter. And on that, it's going to have an address to send your first payment to. Typically, by the time your first payment's due, you will get a bill. If it's not from Prospect the first month, it will be from the investor that did purchase the loan. If you don't receive a bill, you use that first payment letter, and by the second bill is due, you will get.
And you'll get it from who actually has basically bought the loan.
Who bought the loan.
Okay. And with a bank, do they normally hold all their, once they do a mortgage, are they holding
It depends on the
those
bank.
loans?
Some banks do hold a portion of them, some do sell them off.
Okay. And a lot of companies, what about like a portfolio loan?
A portfolio lender is typically a bank that will kind of hold it in-house and service their own loan.
So it's like
And Prospect is starting to do that more and more. They've actually just started to portfolio more of their loans and not sell them off.
are there different guidelines between a portfolio loan or something that's going to be sold in the secondary market?
Not typically. And with Prospect, we all meet the same guidelines. Sometimes, like an individual bank may have their own criteria.
Okay. And, I mean, we know because we're in the business, and you're in it more than I am on the loan, the mortgage side. I know there's been a lot of changes. So can you kind of bring us up to date as to what's kind of been happening, what consumers should know about
There's been a lot of changes.
when they go to get a loan now?
As most people probably have heard, the mortgage industry has been in an uproar over the past few years. But when I first got into this business as a loan originator back in 2002, basically people would submit pretty much a blank application, and as long as their credit score met the loan parameters, they got a loan. They had all no income verification, no asset verification, no employment. I mean, 100% financing, interest only. It was, you name it. And I think that's kind of what happened to the mortgage industry. And it was, the government, I think, created the programs. They were out there, so, I mean, for people not to have to verify anything. So some people that made $30,000 on an application and had they made $70,000. The appraisers were bringing in values that were needed to get the loans through. The reps from the investors were coming into the broker shops back in those days and saying, break out all the loans that you couldn't get done here, we're going to get them done. So it wasn't any one individual, I think it was the whole range.
The way the system was, right?
The way the whole system was. That's all changed now. Basically, everything now is a full income verification loan. 2 years tax returns, recent pay stub, recent bank statements, everything to be current before closing. There's
So which is-
no more of the no income, no asset anymore.
When did all that come about? Do you know what?
They gradually
was it-
started to drop off, and 2007 really seemed to be the end of it. And after that, everything really seemed to go full.
But I mean, when did all that start with the no income? That's been around since
It was-
prior to 2007, wasn't it around for a while?
It was around back in 2002.
But I think it got more and more, less and less strict, though. Even though it was around, it was still basically, like you said, anybody.
If you met the credit score requirement, basically there was nothing on your application for some of these loans. You'd take a little slightly higher interest rate.
Right.
Aside from that, too, and it's kind of funny, but now there's all the licensing laws. So, we have to pass a national exam as well as a state exam for each state that we want to do business in. So the company's licensed, we're individually licensed. At the closing, our license numbers are given to the borrowers. It's funny because no names mentioned, but back when I started in this business, I remember I was a loan processor when I was learning the business, and I remember somebody came in from another field. It was like a hairdresser. 2 days later, his business cards came in the mail, said senior loan officer. He had no background. There was no regulation. Now everything is regulated. We have to pass credit checks, background checks. I've been fingerprinted 6 times.
Wow.
I don't have big ridges they wouldn't take. So
That's amazing. So it's really been.
and we have to keep up with it every year, and there's it's expensive too. So there's a cost involved. So it's going to weed out a lot of people that weren't really serious about their business.
So do you think overall, you think they've gone too far maybe, or you think it's where it should be, or what are your thoughts on that as far as the regulations at
Some
this
people
point?
tend to think it's a little bit to the extreme. People used to be able to have, not a lot of derogatory credit, but you could have some things that happen.
Right.
Now it's, sometimes you could have one trade line on your credit report that's derogatory, and it could hold up a closing. There's been talk that they want to increase the down payment requirements down the road, and it hasn't really happened too much yet, even though we did have one 100% option left. It was discontinued in December through the mass housing. That's temporarily on hold.
So mass housing is
So-
on hold,
Well, we have mass housing programs, but the no
but the
down
100%, okay, the 100%
has
financing
been
option.
temporarily discontinued.
Yeah, I didn't even realize they still had a 100% option.
Well, it came last year.
Before.
We got it. It went away. We got it back. It went away.
Yeah.
We'll see what next year may bring. But
Just curious, June, you may not know the answer. Fannie Mae and Freddie Mac, a lot of people talk about that because ultimately, all the guidelines are coming from those entities, correct?
right,
Now, because you mentioned about the down payment, it allows people to put down 3% for an FHA loan or 5%. So you're saying that the down payments may go up. Is that because of the changing the Fannie Mae and the Freddie Mac and all
ultimately,
those entities? Or
and this is hearsay at this point. I mean, I haven't really seen anything solid on this, but there's talk that what they want to do is over the next 10 years eliminate the role that Fannie Mae and Freddie Mac are going to play in the industry, about 10% a year until they're gone.
so it's
They want
gone.
to privatize lending a little bit, where you'll find more lenders such as Prospect portfolioing their loans and keeping more in-house. And there's talk that down the road that banks will start to require 20% down payments like they did years ago.
Yeah, I was going to say,
Now,
I
it
knew
hasn't
that.
happened
Yeah.
yet, but that seems to be where it may be going.
So, I mean, as we know, being a real estate agent, you as a loan officer, a lot of people are putting, the norm is, what, 5% down?
A conventional loan requires 5% down of your own funds, so you have to prove that it's been in your bank for 30 to 60 days. It can't be gifted. Whereas an FHA loan requires 3.5% down. That whole 3.5% can be gift from a family member.
So, these people,
So
20% down is probably going to be a big change for a lot of people. I don't
instead
know
of
if,
making it easier for home ownership, they're going to make it more difficult.
yeah. And as we know, the home ownership really drives a lot of the economy.
Right.
So, well, we'll have to see how that all plays out.
Should be
Right
interesting.
now, those programs are still here.
They're still here.
The rate's still good.
We have mass housing with 3% down requirement. It's a little more stricter than an FHA loan, where it's going to have household income caps, and it has higher credit score requirements. But for right now, we still have a lot of programs with minimal amount of money down, so it is a very good time to buy.
Yeah, I mean, the prices in real estate certainly have come down, and the rates are still very good.
The rates are excellent.
Yeah, so it is a
You're
good
still
time to
in
be looking at.
in the mid-4 range for 30-year fixed with no points. I mean, they fluctuate daily, and a lot of it depends on credit score, whether it's an owner-occupied property and the type of property, but rates are excellent.
Now, we're going to talk about credit next. You mentioned derogatory credit. Now, what's that mean? Is it somebody's late on a credit card payment, or they have a bankruptcy, or
There's a few different things that they're going to look at. As far as, we'll take a mortgage late to start with. If somebody wants to buy a house and they owned another property where they had a mortgage late, if they have 20% equity with one mortgage late in the past 12 months, they may still qualify for a conventional loan. If it's the mortgage insurance companies, you have the lender's guidelines and then you have the mortgage insurance company guidelines. If it's less than 20% equity and a borrower is going to need mortgage insurance, the mortgage insurance companies won't allow a mortgage late in the past 12 months. Unless it's an extenuating circumstance, like maybe a couple that's went through a divorce, the ex-spouse is in the house and was supposed to pay it and didn't. If we can prove something like that, we might be able to get around it. On an FHA loan, typically they'll allow one 30-day mortgage late in the past 12 months, so it's a little bit more lenient.
So it has to be, a late is considered after 30 days?
Right.
Okay. So the mortgage companies, now you can explain this a little bit too, because anything less than 20% down, somebody has to get what, private?
Well, anytime you put less than 20% down on a conventional loan, you have mortgage insurance. And those mortgage insurance companies are going to have their own set of guidelines as well. That's why they're more
Okay,
strict
so
on
they're
the
more strict.
on the
Because they're
derogatory
insuring,
credit.
they're insuring the portion less than 20%,
Right. They're going to
Right.
insure the lender if you should default.
which
So-
allows all this to happen with putting less than 20% down.
Right.
Are those rates, those insurance rates, are those about the same as they have been, or they've gone up, or what's the?
On FHA, they've gone up quite a bit. I've noticed the factor is just the monthly factor. What they did was they decreased, because on an FHA loan, part of your mortgage insurance is financed into your loan amount, and the other part is paid monthly. The part that's paid monthly actually just increased a few months ago. So it is actually, on one hand, FHA is good because it's, the down payment can be gifted. They're a little bit more lenient on the credit scores, but yet
Right.
they raised the mortgage insurance amounts monthly. So
So, I don't know if you know, like on a $100,000 loan, I mean, is there kind of a guideline on the private mortgage insurance of what you pay
It's-
per 1,000 or per 100?
if you put down the minimum of 3.5%, the factor is 1.15% of the loan amount divided by 12.
I was gonna say that's the
going to be your
yearly.
monthly factor.
And when does that go away?
On an FHA loan, you have mortgage insurance for 5 years. So
Regardless?
you could put down 30% on an FHA loan and you still have mortgage
Oh,
insurance
you
for
do,
5
even
years.
no matter what you put
No matter
down?
what.
Oh, wow.
It's just the type of loan that it is. After 5 years, if you can prove that you have the 20% equity, you can apply to have it removed without having to refinance.
Now, you wouldn't go FHA if you had 30% down, though, would you? What would be the advantage? Is there an advantage, or would you?
Some people that don't have the down payment, because the whole down payment can be a gift, and it's
Oh, I
less money,
see, I
less money
see.
down. And the other difference also is FHA is a little bit more lenient with the credit scores. They're not going to penalize you if you have a 640 score. You're going to get the same interest rate than if you had a 740 score, a 760 score. It doesn't matter. On a conventional loan, if you had a 640 score, which is the minimum for a conventional loan, that's the requirement, you're going to get a much higher interest rate than you would be if you had a 740 score. They're going to penalize you for every 20-point
okay.
increment under a 740. So a 640 score in a conventional loan could give you almost a % higher on your interest rate. So there are some benefits to going FHA, as well as they're a little bit more lenient if you had some recent lates on a credit card of the past or things like that.
So I was just going to say, I mean, someone like you really have to look at every individual case to make sure that you're putting them in the program that's best for the
That's
for the
right.
borrower.
Everyone.
You have to know all that. I mean, there's a lot to know.
We actually recently came out with another program that allows lower credit scores from a 580 to a 639 score that didn't originally fit into the other FHA guidelines. And but they need some strong compensating factors, like no late payments on anything in the past 24 months. They might have to take a first-time home buyer class.
I see.
12 months of previous rental, housing history, whether it's 12 months canceled rent checks or a previous mortgage.
Yeah.
So, I mean, we can do it, but it's just getting a little tougher when we have to kind of build a case for the buyer.
So, credit scores. how does that all work? I mean, you're throwing out these numbers, 580, 640, I mean,
Credit
what is
score's
all
range.
that?
The range is from a 350 to an 850. That's the credit score range. And
So the most
essentially-
you can get is 850?
Right, which I've never seen. Anything in the 800s
What's the highest one
is
you've
excellent.
seen? I mean, is
I
it-
think an 822. An 822.
Can you actually get an 850?
They say you can. I haven't actually seen it. If
You haven't
you're in the
seen it,
800s,
right.
you're in good shape.
I mean, will someone get a better rate if they're 850 or 825?
Essentially, if you're above a 740, you're
Then
going to
you-
get the best of the
okay.
rates. It's when you get under the 740 range that you're going to start to get penalized. But there's always a range of credit scores, and what it is we pull a tri-merge report, which basically is TransUnion, Equifax, and Experian. So all the three bureaus.
Those are all the three major credit bureaus?
Yep, one's always going to be the highest, lowest. You're always going to have the one in the middle. And the reason being is you might have a car loan or a credit card that might report to one credit bureau. It might only report to Experian. So you're going to have that weight on that one bureau opposed to the other two. So you're always going to have quite a range. Whatever falls in the middle is the one that the lenders are going to use to qualify.
All right, so they pick out of the three, whoever's the middle score,
The lowest
that's the
middle
company
score.
they go
If it's two
with.
borrowers, if it's a husband and wife, whoever's, they're going to take the two middle scores and qualify on the lowest middle score.
Okay. So, I mean, I know there must be a lot of formulas behind all that and everything. What is the biggest, what's the number, well, I guess this is a pretty obvious question, but what is the number one thing that's going to affect somebody's credit score?
Oh, there's a variety of different things.
I mean,
One is going
like
to be
the worst thing you can do to affect your credit?
not pay.
Just
worst thing-
be late on your payment?
The worst thing you can do is be late. It's easier with little credit than it is bad credit.
So
If you have mortgage lates, that's going to be much harder to get a mortgage loan in the future. But any kind of late payments, you want to really stay current on everything. They're going to look at the length of your accounts. So what some people do is if some people have credit cards for 10 years, and then they want to consolidate everything, open a new account, switch it over, and they go and close the old accounts, and that's actually a mistake. You want to keep the old accounts open because that's what's going to show payment history over the course of time. They want to see that you've had the accounts for a while. You'll notice sometimes like younger people that don't have established credit, they might only be a year or two old. Their credit score will be lower just because it hasn't had time to season.
I see.
So the length of it's important, the payment history is important, the types of credit's important. Some people, if you have a mortgage, a car loan, and some credit cards, you're going to actually have a better score, pending it's paid on time, than you would if you had like 5 or 6 revolving accounts.
I see.
And another thing to stay away from is like the buy now, pay later, the furniture stores that say, don't pay interest, don't pay
Oh,
for
all
6
those credit
months.
cards from the stores,
Those
yeah.
actually can bring your score down. And
Just
so-
the mere fact that you opened the account?
Right, just the type of account it isn't favorable. And the other thing is,
Wow.
if you have a credit, let me use $10,000 as an example. If you open a new credit card, they give you a $10,000 limit. If you use 75% of that limit and charge $7,500, your credit score is going to go way down. $5,000, 50% limit, it still goes down. You want to keep it under the 50% mark.
So if
Any
you-
account. So you're better off having 5 accounts with small balances than having one card maxed out.
All right, so if you have $10,000 credit, you want to keep it
Keep it
at
under
least.
5,000. You want to keep it under the 50%
Now, when
mark.
do they actually pick that up? Like, for an example, if 1 month you spend $8,000 on the card, you pay it off.
It depends on the
And what
credit
if you
card.
pay it off every month? So if you spend $8,000, pay it off to zero,
That's fine.
spend
as long as you-
$7,000, pay it off to zero?
That's fine, as long
You're
as you pay
saying
it off
the
every month.
revolving
If you
credit-
carry a balance and they
Okay.
report, depending on the credit card, they could report every month or every 60 days. And if it starts to report over 50% of your balance,
So you can spend up to your balance, like you can spend up to $10,000, just
like
say
an
on a-
American Express, and you can pay it off, and that's fine.
So as long as you pay it off, you can pretty much max it out
Right.
and then pay it off.
Right,
But
but
if
if
you
you
don't
carry
pay
a
it
balance
off-
on it and you carry over 50% of that limit, it is going to
Okay.
affect your credit score.
Are you better off having a line that you're showing that you're paying on it, or just pay your credit card off?
They like to see payment history, so if you could, maintain a little bit of a balance, I recommend people have few accounts, small balances. Don't have one with a big balance. And the other thing that a lot of people don't realize affects their credit is inquiries. There's
So
a
every time you-
misconception, I think, about the mortgage. When people apply for a mortgage, there's a little bit of a window, like you have up to 10 inquiries from mortgage companies to pull your credit before it's going to start to affect your score. If it goes past the 30-day window, each inquiry is going to affect your score a couple points. If you apply for a Home Depot card or a car, a mortgage, different types of credit, it could start to affect you a few points each one. So if somebody's on the fine cusp of applying, of qualifying for a certain program, and we're trying to get their score up, I always recommend not to have their credit pulled.
So when you're, yes, within a 30-day period for getting a loan,
Yeah, if
you can
somebody
pull it
did,
10 times and it's not really gonna.
if as
and then
long as it's under a 30-day window, if somebody went to a few different mortgage lenders to,
Yeah, so
basically
they can go to
compare.
3 people and get their
yeah,
credit pulled.
it's not going to drop their score. There is a little bit, they forgive, they recognize that people do shop for a mortgage.
Right.
And they don't penalize them for that. If it starts to go outside that 30-day window, that's when it will start to drop your score a little bit.
Sounds like those store cards are, I mean, really could affect somebody. Because, I mean, you go, they entice you by telling you get 10% off or whatever, or 0%.
It's good to have a few. It's also not good to not have any. Some people pay off all their accounts, they don't have any credit. It's good to,
Right.
you need some, I recommend, the balance of a mortgage, a
Yeah.
car loan, maybe 1 or 2 credit cards.
The other thing is you get these deals in the mail, and then you want to switch your card over. So what you're saying is you can switch to the new card, but don't.
That's fine, but don't close your old accounts.
you just-
If you've had an account for a few years and you have some good payment history behind you, the lenders actually want to see that.
So will they ever call you and say, you haven't used the card for 5 years, we want you to cancel it? Or are they just going to cancel it on you, or, you know what I'm saying? If you go to a card that has a better deal, but you don't want to cancel that first card, do they eventually?
I've seen some that have been unused for a number of years. Well, ultimately, they'll clean it out of the system and close it out, but for the most
But I mean,
part,
at
no,
that point,
you
would
have
it
to
affect
actually.
you, though? You know what I'm saying?
Not so much, but if it's
Because-
used every so often, every couple months, even every 6 months, if you use it a little bit, they're going to look at
So
that
you should
data
use
last
it a little
activity.
bit, yeah, okay. Well, I mean, I think from what you said, a lot of people, you'd think that they have great credit because they pay their bills and everything, but for some things that they're doing, they may not even realize.
Well, it's really important too. It's highly recommended to check your credit once a year. Sometimes I've seen everything. I've seen people that thought, oh, my credit's terrible. I said, why do you think that? They said, because 10 years ago I had some troubles. I said, 10 years ago isn't even shown on the credit report anymore. I mean, it may only reflect the past 7 years. They're really going to put the emphasis on the past couple years. So just because somebody had some bad credit a while ago doesn't necessarily mean that they have a bad score now. But one thing I do talk to people about is if they have bad credit in the past, rebuilding, because they're going to look at the new history. It's important that, you might have had some bad accounts 5 or 6 years ago. They might have went into collection, but it's all about the now. So sometimes it's good to have somebody come in, reopen an account or two just to start getting payment history. And we want to look at that. It could be, 6 months before they're ready to buy a house because we need to get their accounts reestablished so that they'll get their credit score high enough to be able to buy.
Right. And what about if someone has a foreclosure or a short sale, who somebody does?
If
How
they-
is,
It depends on the type of loan program. If somebody was short selling their house, if you go to buy a convention, if you want to buy a new house with a conventional loan, you have to wait 2 full years from the short sale date to be able to buy with a conventional loan. If you're going to use an FHA loan to buy your next house, they want to see 3 years from that point.
so again, the short sale is where you run into problems, you're not paying your mortgage, you go to the mortgage company and say, my house is worth $300, I know I owe $350 on the mortgage.
Right, a short sale is when you're going to
We're going to
basically sell
forgive
it
you
for
the
less than
$50,000, for an example, right?
Sell for less than what is owed.
And then you're saying that was what, a year? No. You said,
If they do that and they sell their house by way of a short sale and they want to rebuy using an FHA loan, they have to wait 3 years.
3 years on that FHA,
And
yeah.
if they use a conventional loan, it's 2 years.
It's 2 years. Okay, so now we go to, the house gets foreclosed on. You stop paying, they take your house, the bank takes your house,
Foreclosure's like 8 years.
8
Yeah,
years?
it's much better off for a short sale to rebuy if you're looking to
Is there anything,
rebuy.
so for 8 years, you're,
It's tough.
That's a
It's
tough
not what
one.
it used to be. The guidelines used to be a lot more lenient, and over the past few years, they've really become a lot stricter.
and what about bankruptcies?
Bankruptcies is, for an FHA loan, it's 2 years discharged and 4 years for a conventional loan.
Okay. Good things to know on that. Let's see. So we talked about, you said 740 for a credit score
Yep, would be ideal.
is ideal. You'll get the preferred rate, if you want to call it a preferred,
Right,
the
but you
better
can get a loan
rate.
down to a 640 score.
And then the down payment,
Down payment on a conventional loan is 5%.
5%.
Of your own funds, and FHA is 3.5%, which can all be a gift from family.
Okay. Let's go into, believe it or not, we only have about 5 minutes left.
Okay, and I just actually
So,
want to
go
clarify
ahead.
one thing that a lot of people aren't aware of. When people say first-time home buyer, a first-time home buyer is somebody that hasn't owned a house in 3 years. So if you had a
Okay.
house 10 years ago, you had it for a few years, you sold it, moved back in with family, and you haven't owned a house in 3 years, you are now a first-time buyer again.
So it's that 3 years you're considered a first-time. That's a good point. 'Cause
Of no ownership interest.
You think it's first-time buyer.
Right.
Pre-approvals.
Pre-approvals.
What is someone looking for when you
This is
get
important because
pre-approved?
there's some misconceptions of what a pre-qualification is and a pre-approval. A pre-qualification is you call me up over the phone, I take your information, and I say, based on what you told me, I think you qualify for X, Y, Z. A pre-approval is completely different. They're going to come in, I'm going to do a credit check on a borrower, I'm going to take a look at their income, and their asset documentation, 2 years of tax returns, recent pay stubs, bank statements, verify where their down payment's coming from, and make sure there's no deductions on their tax returns that would change their income. I'm going to run the loan through an automated underwriting system, which is going to match it against Fannie and Freddie guidelines and give me an approval, which is key because it's so important before people go out and start looking to make sure they're looking in the right price range, to make sure that they're qualified. I had an instance, one of the realtors in my office spent 6 months every Saturday and Sunday taking this one couple out looking at homes. They were pre-approved supposedly through another lender. They went to make an offer on a weekend. They couldn't get in touch with their lender. They called me, and I checked into it. And the woman was self-employed and didn't show any income. And she says that she was never told this from the other lender. She actually couldn't qualify. And she found
Wow.
out after 6 months. So people don't want to waste their
It's a
time for
lot
6
of-
months for yourself or for the realtor. You really want to know what the range is. And a lot of people really need to go over what their monthly payment's going to be. Some people can qualify for something on paper, but that doesn't mean that's what they want to spend.
I hear that a lot. Right, like you said, you qualify for one thing, and when you find out what the payments are, a lot of people aren't comfortable
Right,
with that.
people have their living expenses. Some people are used to vacations, eating out, and it all
Right.
really depends on the quality of life that you're used to.
So when you get the pre-approval, how long is that good for?
A pre-approval is typically good for about 90 days. That's how long your credit report lasts. So if you get pre-approved, 2 months later you find a house and start the process, we may need to update it before you close. But if you got pre-approved 6 months ago, it's definitely time to redo it. Things change on your credit, programs change. So
Okay. Few minutes left. What about, is there help available for people that get behind in their payments?
years ago, there was a lot more programs for people even that had up to 90-day lates on mortgages. Now, I think the best option, if you're behind, is to call your current lender and ask about a loan modification. And I've seen firsthand this can be done without having to go to a third-party company to do loan modifications. You can call directly. I actually have someone that I know that was in one of those option earn programs, the ones that give you like 4 options to pay your loan. And if you pay the minimum amount, your loan actually grows on the other end. And he went in to
Wow.
modify it, and they knocked it down to his original loan amount. They took $30,000 off, they waived it, added 10 years to his term, and fixed in the adjustable rate to a fixed rate. And that
So
was all
the-
done without paying anybody to do it.
Wow, so the lenders are really working with...
The lenders are working with people a lot more than they used to.
I hear these stories about, you call them, and as long as they look you up, and as long as you're paying your mortgage, they don't... It's almost like you have to be...
I think
Is that
years
still
ago,
true? You
that
have
was
to be
more-
behind before they even talk to you?
No, I think there was a lot of misconception about that, and I think years ago, a lot of people were telling people, just don't pay your mortgage, and you'll get a modification.
Right.
The lenders are really willing to work with you more now.
They might go, well,
It's
now...
not saying it's going to work for everybody. They're going to look and see if there's a hardship. They're going to look and see, what you have in the bank and what your income is. But, if you're encountering some kind of a hardship, they're definitely willing to work with you more than they were in the past.
Okay, well, that's good news. And what about when somebody should think about refinancing? What's kind of some...
Refinancing, the lenders are going to look to make sure that there's a 5% savings in the monthly payment. So there has to be, depending on what the loan amount is with the interest rate change, it has to be 5% of savings. So you could save a lot in the interest rate, but then if your property taxes went up from when you took out the last loan to now, after everything's said and done, the new payment has to be 5% more.
And
5%
then
savings.
at that point, it's worth it for you to refinance?
That's when it's worth it. That's
Okay.
when the lenders will do it.
Real
Or-
quick, go ahead.
Or there could be other compensating factors, cash out, having to buy out a spouse, they'll allow it for something like that.
Okay. Real quick, where do you think interest rates are heading?
If I knew that, I'd be a rich woman, but I think they've been getting lower every day, and, right, like I said, they're in the mid-4s right now, and hopefully I'd love them to see them keep going. I don't know if that's going to happen, but
All right, but they're good. Well, that's all we need to know. People need to know they're good rates.
they're good rates. It's a good time to buy.
You've talked a lot of good information. How would someone contact you if they wanted to talk further to you?
The best way to contact me would be my cell phone, which is 617-548-8720, or you can reach me at the office, 978-927-8700.
Thanks a lot, Stacy. That was
Thank you for
great.
having me.
Well, thank you again for joining us here at Jason's in the House. We really appreciate it. If you have any questions for me, you want to be a guest on the show, or anything at all, please feel free to visit my website, which is jasonparisellateam.com. See you next time, and thank you to BevCam for all their help. Thank you.